We think the Aussie dollar could end the year around 72, 73 cents. And that's primarily on the view that we think that the conflict will not prove longer lasting, but importantly too, that the RBA still has a little bit more work to do in terms of rate hikes.
Rodrigo Catril, welcome to the business.
Hi Alicia, thank you.
For a risk currency, the Australian dollar is holding up pretty well in the face of a major global shock. What's behind the resilience?
Well, there's actually several factors playing into this dynamic. The first one to highlight, of course, is that we had a central bank that it has been hiking into this conflict, and the conflict itself has raised a lot of questions around inflation, and that has triggered sort of a market response that the RBA will be more inclined to remain hawkish or to continue to hike in the face of what it looks to be an inflationary shock. So that's been very helpful for the currency. The second factor that's also worth emphasizing is that this is an energy shock, and Australia is a net energy exporter. So overall, there's a net positive for the economy, and when we see ourselves relative to the rest of the world, that benefits the Australian dollar. And the last point to make, which is quite interesting, because when you talk about this sort of big conflict, which has been very, very important and a big shock, if you like, the equity market and risk markets have not really tumbled or have not suffered significantly. So one way of sort of measuring this, if you look at the volatility in equity markets or the VIX index, the Aussie dollar tends to underperform significantly when the VIX index jumps and stays above 30. And at the moment, it's only done that only a couple of times and for a very brief period of time. So the Aussie dollar remains risk sensitive, but risk assets have not been super sensitive to the conflict.
For context, the Australian dollar fell around 4% or so against the greenback in March. It's now up about 2% in April. Do you see the currency, it's now about 70 cents, continuing to head higher?
Well, the conflict and how long this conflict lasts is super important. At the moment, our base case is that we will see an eventual resolution, which plays to this resilience that we've seen to the Aussie dollar continuing. We still think that the Aussie is probably like a 70 to 75 cent currency over the course of this year. The RBA, as we've spoken, is a key sort of assumption in this story.
As you say, for now, inflation is the RBA's worry. But if this conflict drags on, could the worry for the RBA become a growth or recessionary problem? And what does that do to your outlook for the dollar?
So I suppose when we think about the Australian economy, at the moment we are suffering an inflationary shock from the conflict. If there's a slowdown in the Asian economy because of the conflict, then that will have an impact in terms of the growth outlook for Australia as well. So for now, that is not our base case, but it's something that we're very mindful, and we will be very mindful of in terms of how that evolves if the conflict extends for another month, for instance.
And Rodrigo, can you put a figure on where you think the dollar might end up by the end of the year?
Well, right now, our forecast, we think the Aussie dollar could end the year around 72, 73 cents. And that's primarily on the view that we think that the conflict will not prove longer lasting, but importantly too, that the RBA still has a little bit more work to do in terms of rate hikes, whilst in the US, actually the risk is that by the end of the year, the Fed is actually cutting rather than hiking. So that's very supportive for the Aussie dollar.
Rodrigo Catril, thank you so much for your time.
Pleasure.